Hi, my name is Rachel Hare, and today I'm going to be going over GAAP, or known as General Accepted Accounting Principles. So your learning objectives, by the end of this presentation, you should be able to use the General Accepted Accounting Principles in order to read and understand financial statements, and also identify the key standards and procedures of the General Accepted Accounting Principles in order to prepare financial statements. A quick snapshot of GAAP is that GAAP is a common set of accounting principles, standards, and procedures that companies follow when they compile financial statements. When and where is it used? It's used whenever you're preparing financial statements, when you're reading financial statements, and when investors review company information to determine whether it's a sound investment. And who commonly uses GAAP? Accountants, or whoever is making financial statements, and then also investors who are trying to read, or anyone trying to read financial statements so they know what they're reading and what they're looking at. So it's a common thing. What is the benefit of knowing this? Someone should be interested in this because accountants prepare financial statements such as revenue recognition, balance sheets, etc. using GAAP. So this is important because this is the regulations that every company in the U.S. needs to use in order to keep statements regulated and similar, as to not have different styles, and also prompting better information into the marketplace. And also it can help in the real world in case you ever need to prepare your own financial statement, or if you ever find yourself reading one or plan to invest in a company and need to know what their numbers are, just so you know exactly what you're viewing. So the first part of GAAP is recognition. This is what items should be recognized in the financial statement, such as assets, liabilities, revenues, and expenses. This is what you want to stick to. You want to stick to the minimum, the standards of what GAAP is requiring. You don't want any extra information. As you can see over in the balance sheet, that have their current assets, their property, plant, and equipment, their intangible assets, information such as that. They don't have anything extra. They just have the bare minimum of what they need. Next for GAAP is measurements. This is what amount should be reported for each of the elements reported in the financial statement. After that, we have presentation, and this is what line items, subtotals, and totals should be displayed in the financial statements, and how might items be aggregated within the financial statements. So over here I have a cash flow statement. This is a good example because it has their loss in red and parentheses, which shows that that is a negative number. They also have the lines that they need, so they have their cash flow for year end of December 31st, so that's how normally they should have them listed. Also, back on the balance sheet earlier, you can see that they have their lines. So under total current assets, they have a single line, but then down under total assets, they have their double line showing that it's the end of the assets. After that, we have disclosure, which is specific information is most important to the users of financial statements, and also disclosures supplement and explain amounts in the statements as well. Also with the disclosures, they have a checklist, and this checklist begins with a section on general disclosures, and then includes sections focused on balance sheets, income statements, statements of cash flow, and additional disclosures. This is to explain their numbers, not to make excuses and try to explain why they're doing so poorly or why they're doing so greatly. It's just to explain their number, and that's it. So my first real-world example is an article on anti-GAAP reporting proves a growing menace. This article reported that 96% of the S&P 500 companies reported anti-GAAP information in their fourth quarter reports. This means that they're giving more information than the GAAP standards, so they're throwing more information in there that they need just to make their company look better than what it actually is. They're using EBITDA, which is the net income under regular GAAP standards, but EBITDA is when they add back interest, tax, depreciation, and amortization into that number to make it seem better than what it actually is. The next example I have is that firms say goodbye to prettied up financial reports. Again, this is just another article on how companies are putting more information into their reports than actually needed, trying to make their company seem better than what it actually is. This is kind of deceiving their investors and making it think that their company is a good investment. They actually used a really good example in their article that the Halliburton initially reported $64 million income when after their reports were reconciled and put to GAAP standard, they actually ended up losing about $2.4 billion. So as you can see, they want GAAP is just the standard of what they need, the bare minimal, so that every basic information is reported and you can't pretty it up or make your company seem better than what it is. So that was a quick snapshot of GAAP. So now you should be able to use GAAP in order to understand financial statements and why the information on the statements is there, and also to use the standards and procedures in order to prepare your own financial statements if needed. Thank you for watching. My name is Rachel Hare again, and if you have any more questions, I have my LinkedIn right there for you.